Welcome to Bionaut, the heartbeat of tech in MENA. We bring you raw stories and sharp insights from the founders, investors, and leaders building the region's startup ecosystem. Today, we're doing a deep dive into the journey of Sarwa. You've probably heard of them, the Middle East's big investing platform. They just recently passed 20 billion AED, that's dirhams, in cumulative trading volume. Pretty impressive.
That's really impressive.
And we're getting a story straight from the founder and CEO, Mark Shawan. This isn't just, a glossy success story. It's a really candid look at customer validation, product development, fundraising, and importantly, founder intuition.
Yeah, and what's great is Mark's story gives us these, concrete lessons. Really useful for any founder, any investor trying to figure out the MENA startup scene.
Right.
We'll dig into the specific hurdles, the big decisions that really shape Sarwa. From when it was just a side project to where they are now, you'll get real insights into those strategic shifts, those aha moments that were, key to their growth.
Okay, let's unpack the start then. Sarwa began, like you said, as a side project. Mark and Jad Saye. The idea was simple. Make investing effortless with a robo-advisor.
A common starting point for fintechs.
Exactly. But bam, right away, a huge roadblock. This $500,000 capital requirement just to get licensed. Mark said he felt pretty demotivated, called it insane for a startup.
And you can see why, right? $500,000 before you even really start. That's daunting. How did they get past that?
It sounds like it could have stopped them dead in their tracks.
Absolutely. And look, this is something so many early-stage founders run into, these big regulatory walls that seem impossible to climb.
So what was the key for Sarwa?
The game changer was getting into a government accelerator and, crucially, into a regulatory sandbox.
Ah, the sandbox. Okay.
Right. That move slashed the capital requirement.
Yeah.
But just as important, it signaled, a more flexible environment from the regulators. Actually being the first company to graduate from the DFSA, the Dubai Financial Services Authority's sandbox. That was huge.
A real milestone.
Totally. Mark said it genuinely shifted his mindset from uncertainty to, okay, we can do this, determination. It just shows how powerful regulatory innovation can be for building up a startup ecosystem.
Now, here's where it gets really interesting, I think. Their customer validation. It wasn't the usual playbook. No big surveys, no deep market analysis reports. It sounds like it was more gut instinct, stories they heard, and signals from early investors. Mutt just knew the problem was massive in the Middle East.
Yeah, he saw people facing real barriers to investing.
Sure.
Right? Defaulting to things like gold or real estate because the regulations were just too complex.
Exactly. So how did he validate that feeling, that hunch, without the typical product market fit work we always hear about?
Well, I think Mark's approach was really smart, very perceptive. He talked to everyone, ecosystem players, friends, family, consultants, just cast a wide net.
Okay.
And the feedback kept coming back the same. There's a real pressing need here. But here's the kicker. Even before he had that traditional validation, he was getting commitments.
Yeah.
Angels, VCs, they were buying into the vision.
So the story itself was the validation, in a way.
Precisely. Mark actually said the validation wasn't financial. It was narrative-driven. The story we had built was enough to move us forward. And that's powerful. It shows that sometimes your vision, the story you tell, that can be your strongest early validation tool for customers and investors.
Makes sense. So early on, the team was Mark on product UX, Jad on tech. But they saw a gap, marketing. What happened when they brought on Nadine Mezher as a third co-founder, as CMO?
That was a really strategic move, bringing Nadine in early, focusing specifically on building long-term trusted relationships with customers. That's a key lesson for anyone trying to scale.
Proactively filling those skill gaps.
Yeah, you have to identify them early. But what's also fascinating is how honest Mark is about a really tough period. After they raised $1.3 million, pre-Series A.
It sounds great on paper.
Right, media hype and everything. But
Yeah.
internally, they only had 8 customers. 8. Mark remembers looking at Jad and asking, are we wasting everyone's time? That clash between the external noise and the internal reality. Growth was painfully slow. The account opening process still took like 40 minutes.
Oof, that's brutal. 8 customers after raising over $1 million. That doubt must have been immense.
Absolutely. It highlights that tough, often hidden early grind of a startup.
So what does that mean for someone listening who might be facing that same slow start? How did Sarwa push through that feeling?
Well, a couple of things. They focused on small wins, which can be really important psychologically. Things like attracting good people, talent from places like UBS and McKinsey. That helps build belief.
Okay. Tangible progress, even if small.
Exactly.
Right.
But more importantly, they adopted a clear metric. Paul Graham's framework aimed for 5% weekly user growth consistently.
Right, the compounding effect.
Mark said, once we started hitting that 5% weekly growth, it completely reset what good looked like. It helped remove a lot of doubt. It gave them something concrete to aim for, shifting their thinking from just, linear struggle to seeing real exponential potential. It's a powerful tool for founders to manage expectations and track actual progress.
Okay, so they found their growth rhythm. As they grew, they developed this multi-channel strategy, CS, nurturing leads, using advisors for high-value clients. Referrals became big too. But you mentioned they also shifted their PR approach. What did that look like?
Yeah, this touches on building sustainable trust. They moved away from just sort of chasing media coverage.
Quick hits.
Right, towards publishing deeper, more valuable content, leading with authenticity. It's a long-term play, building real credibility, not just headlines.
Makes sense.
And Mark's biggest product lesson, this is huge. He said, product market fit isn't a one-time achievement. It's something you have to keep earning.
Constantly revalidating.
Exactly. They started with passive wealth management. But post-COVID, the feedback started pointing to something else, a bigger adjacent opportunity, active trading.
So a real pivot in the offering.
A major one. This wasn't just tweaking a feature. Mark called it shifting from feature experimentation to proper product market fit work, testing a whole new value proposition. He's very clear. I don't think we'd be as big or even still here if we hadn't pursued this adjacent opportunity.
Wow.
It's a massive insight for founders.
Right.
Be willing to actually pivot your core product based on what the market is telling you, even if it means repositioning the entire brand.
That willingness to change seems key. And COVID clearly affected Mark's planning, too. He moved to shorter-term road mapping, focusing on big themes for the year. He also warned against listening only to the loudest customers. How does that translate for listeners thinking about their own product development?
It means you need to interpret feedback really carefully. For instance, clients asking for more personalization might actually be hinting they want a self-directed trading platform. You need to dig deeper.
Understand the underlying need.
Precisely. And Mark makes this critical point. In wealth management, the most vocal clients aren't always the ones driving most of the revenue. So you have to proactively talk to your most valuable users, not just the squeaky wheels. Make sure your roadmap serves them.
Good point.
And his view on volatility is really interesting, too. Most people see it as a threat.
Definitely, especially in finance.
But Mark sees it differently. He calls it a powerful growth engine. Think about it. Stable products are kind of boring. They limit engagement. But volatile ones, they spark excitement, conversation. Think about the crypto boom.
True, everyone was talking about it.
He literally says volatility can be the best marketing function a fintech could ask for. The catch. You have to survive the lows.
A big catch. Okay, beyond product, Mark has some other contrarian views. He apparently hates meetings and questions the automatic drive to raise VC money. Tell us about that.
Yeah, he's definitely got his own style. He prefers a light, flexible communication flow. Admits, I hate meetings. The whole team only meets formally every 6 to 8 weeks or so.
Really? How do they stay aligned?
Heavy reliance on Slack. Real-time chat. The goal is to avoid micromanagement and those forced updates nobody likes. It's about balancing trust and visibility without drowning in meetings.
Interesting. And the VC point?
He thinks pricing is often misunderstood, especially in the region. Companies give services away too cheaply, he argues, and that hurts long-term sustainability.
Undercutting their own value.
Right. And he really questions if every startup should automatically chase venture capital, especially now with the macro environment. IPOs are rare, big acquisitions limited. He believes many founders might actually be better off on a leaner, more capital-efficient path. Not everyone needs to build that $100 million revenue machine VCs look for.
That's a perspective you don't hear every day, especially from a successful founder.
It's definitely food for thought.
So we've covered a lot: regulations, validation, pivoting, funding philosophies. If you had to boil it down, what's Mark's ultimate #1 lesson for founders listening right now?
I think his final piece of advice is maybe the most powerful. It's about finding the balance. You absolutely have to listen to your investors, your advisors, but you also have to trust your own instincts.
That balancing act.
It is. Because, as Mark warns, not all advice fits your unique business, especially from people who haven't lived and breathed your vision day in, day out. Founders need that confidence, that discernment, to know when feedback clicks and when, actually, they need to push back.
Especially on core things.
Exactly.
Yeah.
Critical stuff like governance, company culture, you have to own that. Ultimately, success seems to be this blend of data, feedback, and that gut intuition. And having the courage to just move forward even when the path isn't perfectly lit. Owning your vision.
A powerful takeaway. Okay, that brings us to our final thought. Considering Sarwa's journey, facing down those tough regulations, making that big pivot based on market signals, what do you think is the bigger risk for founders in fast-moving markets like MENA? Is it sticking too rigidly to that original vision, or is it chasing every shiny new opportunity that pops up?
Oh, that's the million-dollar question, isn't it? It's such a tough balancing act.
Yeah.
You need that strong vision. Absolutely. It guides you, attracts people. But in a market evolving as quickly as MENA, being too rigid, well, you could miss the boat entirely.
Mm-hmm.
But on the flip side, chasing everything, that just burns resources, dilutes your focus. I think Mark's story, especially that pivot to active trading, suggests the real skill is figuring out which opportunities are genuinely adjacent, ones that build on your core strengths and fit in the evolving vision, versus those that are just distractions. It's about strategic flexibility, not just reacting.
Strategic flexibility. I like that. Definitely something for founders to chew on. For more stories like this, subscribe to Buy-in On's newsletter and stay updated on the latest in MENA's tech and startup ecosystem.